But if you see multiple long wicks at the same level, that's your signal. Smart money is testing that zone, triggering orders, but price keeps getting rejected. That's a strong clue the market's about to move in the opposite direction, and when you see it, that's your opportunity. Let's talk about another smart money trick: large candles forming during a sideways market. These big candles might look like the start of a breakout, but often they're traps. When price is moving sideways, the market is in a phase of indecision or accumulation. Price is bouncing between support and resistance. It's not trending, it's building pressure. Smart money loves these moments. It gives them time to build positions, but they need liquidity. And that's where the large candles come in. Here's what happens. Big players suddenly push price hard in one direction. That giant candle creates excitement, it screams momentum, retail traders see it and react emotionally. They jump in, fearing they'll miss a big move. That's exactly what the big players want: more liquidity on the other side. The large candle becomes a trap. It looks like a breakout, but it's just a trick to get traders in. Price might even break out of the range, but then quickly snaps back inside. Classic liquidity grab. Why? Because breakout traders place entries just beyond the range, and stop-loss orders sit there too. By triggering both, smart money fills their orders without moving the market too much. It's emotional manipulation. Big candles create FOMO. They pressure traders to enter without confirmation, a mistake many of us have made, myself included. So how do you protect yourself? Volume is your filter. If a large candle forms on high volume but price quickly reverses, that's a strong sign it was a trap. Smart money used the volume spike to grab liquidity. If it forms on low volume, it might signal weak conviction, and the breakout probably won't last. Let's break down one of the most aggressive forms of candlestick manipulation, the gap trap pattern. It's a setup designed to mislead traders at the exact moment the market opens, especially during the New York session. Here's how it works. A bullish gap trap happens after a downtrend. The market opens with a gap down, convincing traders the drop will continue, but instead of falling further, price snaps back hard and launches upward, forming a strong bullish candle. A bearish gap trap is the opposite. After an uptrend, the market opens with a gap up, pulling in breakout buyers, only to reverse sharply and collapse, forming a strong bearish candle. At first glance, it looks like a sudden shift in market sentiment, but most of the time, that shift is not organic. It's manufactured by smart money to create liquidity. Here's the trap. Retail traders react emotionally to the gap. In a bearish gap trap, long traders believe the move will continue. Meanwhile, breakout buyers enter after the gap up. But as soon as price reverses, both groups are trapped. Their stop losses, conveniently sitting just beyond support or resistance, get triggered. And that's where smart money steps in, using the flood of liquidity to open their own positions. The gap is psychological. It tricks traders into thinking the current trend will continue, but when price violently moves the other way, confusion takes over. Traders panic. Some close their positions at a loss, others reverse their trades, and that emotional reaction is exactly what big players want. The first part of the manipulation is the gap, engineered to provoke action. The second part is the reversal, designed to trap and exploit. Once the reversal starts, stop losses get swept, and that liquidity becomes fuel for the real move. To the trained eye, this trap becomes an opportunity. So, how do you trade the gap trap? Let's say you spot a bearish gap trap. The market gaps up, but then quickly rolls over and reverses. That's your cue to go short. You place your entry at the close of the reversal candle, the one that forms right after the gap move fails. Your stop loss goes just above that candle's high, and your target is the next key support level. Now look at what happened next. The market reversed cleanly, hit the first target, and kept dropping even further. That's the power of trading with smart money. If you spot a bullish gap trap that gaps down, then reverses strongly, you can look for a long entry, expecting continuation higher. The key is to avoid reacting emotionally to the gap. Instead, wait for the trap to spring, and then trade in the opposite direction. Let's break down one of the most overlooked manipulation patterns in the market: the power doji. At first glance, it looks harmless, a small-bodied candle with long wicks on both sides. But beneath the surface, this candle tells a bigger story. The small body means price opened and closed near the same level. No real progress in either direction, but the long wicks show that both buyers and sellers tried to take control and failed. It's a clear sign of indecision, and more importantly, a setup